Good afternoon, everybody. Today I'm chatting with Brian Dalton from Altius Minerals. Guys, today's a little bit of a shake-up from what we normally do on these interviews. I think that for those of you who are investing in mining companies, there's risks that you need to consider, and there's nobody better to talk to about these risks than somebody who's actively making these decisions and evaluating mining projects than someone who runs a billion-dollar company and is deploying capital similar to what we do, but on a much bigger scale. In this interview, we get into how Brian thinks about royalties versus streaming and why he prefers to invest in royalties. And also we get into what's happening here in Canada from a regulatory perspective and how challenging it is to move projects forward. We also discuss Altius, which is the company that Brian runs, and what investors should be looking out for out of the company over the next year. All right, everybody, enjoy the interview. Brian, thanks so much for joining us today.
Thank you for having me here.
So I always like to start off these interviews asking companies about the commodities that they have the most exposure to. In your case, you guys have a portfolio ranging from potash, iron ore, copper. It seems like at this point, you guys are getting your most revenue generation from your copper asset in Brazil. Why are you bullish about copper? What is it that you're thinking about when you think about the copper market right now?
Well, I tend to try my very best to ignore all the demand side noise, right? So what's going on in China today? What is electrification going to do to demand? What's industrial output? I mean, I know that's useful and it's half the equation, but it's not constructive with the timeframes that we invest around to think about that too much. And we all know that narrative changes daily in a lot of cases. So we focus on the supply side of the equation, and there it's very easy to get constructive. We're now dealing with whatever it is since about 2011, 2012, since there's been any meaningful capital investment in growing out new copper supplies. Sure, there's been some incremental growth and life extensions and those sorts of things, but that's an extremely long period of time to go without having a wave or a period where a lot of capital piles into the industry and grows back supply. And let's face it, these are mines, they're finite lives, and if you don't continuously invest in supply, eventually it falls off and you end up with a supply-demand imbalance. And in the 30 or so years I've been in the business, like this period of time without real investment is practically unprecedented. So it's very easy to get bullish with that setup just by looking at how dire the supply situation is in the next several years.
Okay, so like you said, you've been in this business for 30 years and you've seen some stuff, we'll put it that way. Something I like asking CEOs of companies like Altius is the current regulatory environment in Canada and sort of how challenging it's become. I know you guys have investments all over Canada and particularly had some struggles with your coal investment in Alberta in the past. What's your read right now on the regulatory environment in Canada? And what do you think we could be doing differently in Canada to try to foster a stronger mining environment?
Well, my current read is that it's progressively tougher and tougher. I know there's lots of nice things being said about the need for domestic supply chain security and the ability to meet our own decarbonization goals, all those sorts of things. But the reality is on the ground, the increasing difficulties to go from a meaningful discovery to production, it's just harder and harder every day. And I think it's a really underappreciated factor and risk when investors think about future discounted cash flow models. Generally speaking, all of those models are far too optimistic about when a mine can, or even if it can be built, and when it'll generate cash flows. And it's just getting longer and longer. But the other side of that is it goes to what I just talked about on the supply side. it's just another challenge, so that even when we get pricing now, and we inevitably will, there will be incentivization through price at some point. But the ability for that to translate into supply, and supply that can come quickly enough to meet deficits, is a very big question, but it won't be quick. So it's just another bullish factor if you want to take sort of the glass half full viewpoint here.
This question might be a little bit too high level, but I'm going to ask it anyways. When you guys get approached about investing in a project in Canada, and let's say it's a development stage project, what's that sort of regulatory hurdle you want to see it get through before it becomes really attractive to you, where you're like, okay, now they can really move it forward?
Well, we actually invest ourselves in developing projects, so we'll actually take that, that time frame into account, sometimes with 20-year horizons. So, but that makes us, I think, quite an unusual investor. So I might not be the best one, uh, to address that. But really, it is that. I mean, until you get to that, I would say the fully funded status, because that, no one's fully funded unless they're fully permitted. But fully funded is pretty much when you can feel pretty comfortable that, all of the barriers have been or enough of the barriers have been beaten down that you can say that I'm now investing in a project that will ultimately produce whatever metal it's designed to produce. It doesn't say much about whether or not how much profit it'll make or anything else, but it at least says that this isn't likely to be an orphan project that never got built.
So it's the first time we've had you guys on before, and for most of our audience, I think you guys are probably a new story for them to hear about. What's the high level overview of the company?
Yeah, so we're very much focused on the royalty side of the equation. We don't try to bring projects to production. And the way we build our royalty portfolio is two ways. We have been periodically and generally counter-cyclically active in M&A type markets, whether that's funding producers and helping them build projects in exchange for royalties, or whether it's creating our own projects and then farming them on to mining companies while holding back royalties. Those are sort of the two prongs. And then more specifically, we have, and this is particularly true on the M&A side, we've generally steered clear of the precious metals royalty space. And the reason for that is that we've always felt that it was very well served. The competitors are quite formidable, have very much more attractive costs of capital than we deem ours to be. So it just never made a lot of sense. But on the other hand, um, it's been considerably less competitive on the non-precious side. So whether that's industrial metals or commodities like iron ore, or the base metals, now battery metals, certainly potash, key area for us. So that kind of defines our space. Royalties, little bit of differentiation in that we'll also do self-creation of royalties, which makes us different than most of the other metals royalty pairs. And then that emphasis in M&A anyway on non-precious metals. And I have to caveat that we don't have that same kind of bias when it comes to self-generating projects. The competitive factors don't exist when you're out looking for exciting mineral lands, whether it turns to be out to be a base metal or a gold project. We're relatively indifferent in. And in some ways, we actually like the precious metal side there, just because there's a much wider customer base, if you will, of companies that might want to take that type of project on over, traditional big base metal projects, which I think only the bigger companies can handle.
So when you guys are when you guys are looking at acquiring a royalty, do you guys have any sort of criteria in terms of the investment size you like to make and what you like that royalty structure to look like?
We very much prefer royalties over streams. Royalty, by definition, or at least by our definition, is a true interest in land. It's not a contractual obligation of anybody. And, we have examples in our portfolio of royalty assets that have come very well through even bankruptcy proceedings and survived intact. That's not the case typically if you're dealing with streams. As far as size goes, we don't shy away from bigger type opportunities, although we may consider in a case like that uh, sharing something with other royalty companies. That's another nice thing about royalties in general is that because they're not operating interests, it's relatively easy to structure partnerships, without the real risk of conflicts and those kinds of things. But I would say that we try to balance our overall portfolio across those key market areas that we're in. So sub 200 million is probably not a bad guide for us. And even, in that 100, we're at of a size where, a 50 or $100 million investment can really move the needle if we have conviction.
And in realistically, from looking at your deck, it sounds like you're kind of looking for on a discounted cash flow basis, that sort of 3 to 4 times return payback on what you're paying.
Yeah, be careful there because when I say we're counter-cyclical, I really mean it. We let the commodity cycle do a lot of that work for us. So we've made acquisitions back, say, in 2015 and 2016 when the analyst community assessed them using price decks of the day. They may have assessed them as being, 6, 7, 8% IRR type investments, with, whatever that implies, 10 or 12-year paybacks, where realistically knew we were buying at bottom of cycle, and inevitably the cycle turned and we ended up, Chapat is a good example, right? That was the kind of narrative that we kind of return that we were getting. I don't think we've ever had less than double-digit yields against investment price since we made the acquisition. Um, so yeah, it's hard to make that call unless you're actually assessing what price. Let the cycle do the work for you.
So it kind of sounds like when we see Warren Buffett go all cash and then he's kind of waiting to buy stuff. And I've noticed you guys have been kind of inactive over the last couple of years in terms of major transactions. Is that sort of the strategy? You guys have your war chest ready, and then when you find something that just seems like it's just at the bottom of the cycle, that's when you go and strike?
Yeah, I think that is fair to say. We don't think that commodities markets and the kind of wild cycles that exist within commodities markets are necessarily made for dollar cost averaging, if you will. But there is something I would point out is like a lot of the acquisitions we make, particularly if it's a little earlier stage, or even the M&A type transactions we make in down cycles, what we're really looking for is, for the most part, big resource lives or the potential for big resource lives. So when the market is ugly and prices are well below incentivization, we're going to be active in M&A. But when things get more constructive, our expectation is that the operators of the assets that we hold royalties on and don't have to contribute to their future growth will choose, because they're incentivized to do so, to invest in those assets and grow out the production profiles. So that's kind of where we start to look for growth in that part of the cycle. So M&A more focused when things are more opportunistic, and then you just let the organic portfolio and your operators uh, come in and grow out your production profile. So being inactive doesn't mean we're inactive. It just means we're not spending. Our portfolio is still quite active in that period.
Yeah, absolutely. So you mentioned that you prefer to do royalties over streams. Why is that?
Well, it's just the nature of the ownership. I think, a royalty typically is a much more secure form of ownership. So when we end up with a royalty on a project, just use an example of a project that we create ourselves and we farm it out and retain a royalty. Our title of that royalty is registered alongside of the owner of the rest, whoever buys the actual ownership interest. So if they go ahead then and enter into financing arrangements and post their asset as security, and something goes wrong, our interest isn't actually part of the collateral package. Like that's not something to rank behind anybody, a bank or anyone else, and have to defend. It was never part of the package to begin with. So if that company proceeds to bankruptcy and the asset changes hands in that bankruptcy, we've never been, we weren't even in the creditors list. The new owner shows up and it acknowledges that this existing royalty is on the project. So we actually have that set of examples in our corporate history now of our assets surviving through that. Whereas a stream, it's a contractual interest. And yes, there's ways you can really, make that security strong, but still it's, you are in a list of contractual rights that sit, within that overall capital stack of the business.
Okay, that's interesting. I've never actually realized that that's the big difference between streams and royalties. So, what is your guys' due
Oh, there are
diligence?
there are tax advantages to the streaming structure. There are
Okay,
definitely tax advantages to that, and I think a lot of the financial engineering that's gone on, was largely driven by that. So we pay more taxes generally. We are, but we accept that's a trade-off we're quite willing to
to
accept, and we
reduce
price we price for it as well.
to reduce that risk.
Yeah.
That make it, it makes a lot of sense. So, what does your due diligence process look like when you guys are looking at maybe generating a project or helping it along, or even doing a royalty deal?
I would say that we're a very technical investor royalty company. I mean, across that broader landscape of businesses, the royalties and streamers, there's some companies that I would frame as being more financial and others that I would consider to be more technical, almost as end members, if you will. But yeah, we're assessing a project, I guess in the way that lots of others are around whatever technical reports that exist and making our own calls on its longer term viability on the capital and operating cost estimates and all of that. So that's not wildly different, but where we go much deeper than the technical reports would be around areas of future upside and optionality. Um, as a very big part of our assessment. We're not that interested in relatively short life things where what you see is what you get with maybe a little bit of variability. We want to see a lot of long-term variability over decades. That's where we think the magic exists. It's in all those things that technical reports can't talk about or can't try to quantify that we think that's what our job is for our shareholders is to make those calls. So that would be a differentiator for us, we think.
So maybe you can indulge us a little bit here for our retail audience that reads technical reports. What are the things that you think are often, we'll say, opaque or things that stand out to you when you read technical reports that you often find yourselves sort of rolling your eyes at or being like, we don't really trust this information?
Well, it goes both ways. I mean, I think that the regulatory process and the constraints that are on around that people have who write these reports, limit that to a certain degree. There's going to be assumptions in there that everyone is free to make and insert their own favorite assumption around prices and things like that. But obviously, some good technical knowledge in terms of assessing, how far along metallurgical performance, for example, is, how sound the engineering is. But again, I think that the nature of these reports right now and the constraints that are around that are on the authors, um, it's come a long ways. But it's the other side too that can get exciting, right? You can't wave your arms in a technical report about, we've only used this much of the mineralized footprint in our resource estimate and in our mine plan because that's all we're allowed to do. But you know that's where oftentimes, particularly in big base metal mines, because you drill off so much and you make your mine plan, it's the call around, this isn't a 20-year mine life. This is a 40-year mine life, or it's a 20-year mine life at twice the production rate that everyone else thinks they're buying, right? So, but yeah, I mean, it's as solid as the authors, and I mean, these things have different categories and different titles for good reason. Scoping study is just that, and it can have a lot of arm waving, whereas a definitive feasibility study you can hang your hat on much more firmly. So, yeah.
How big's your technical team?
Uh, Well, if we include the renewable side, so that's a separate group that works out of New Hampshire, we'd be somewhere around 15 to 20 people at any one
Okay.
time, including sort of consultants who we've worked with for a very long time. But we keep an in-house, strong technical team in-house. And one of the things we've really tried to do over the years, a lot of times you'll see groups blow up their technical group teams in the good times, right? And really scale things back as soon as it gets a little tougher out there and prices come down and margins go down. But we've really tried to maintain our core team through all parts of the cycle. And in fact, you know, there's more value that can be generated from retaining that technical knowledge in down cycles than up cycles. So it's a small team. We've been together a very long time, and we pretty much all know what the other guy or girl is going to say before they even say it. But yeah, it's a tight knit group.
Okay, so I got to ask you this because it feels like we're in a bit of an upcycle right now. What does the deal flow out there look like right now? Are you guys looking at lots of projects, or is it a little harder to find things in this kind of market?
It's not the bottom of the cycle, and I can't really say we've really come into the upcycle. It's easy to just look at a price chart for copper, for example, and say, well, it was, you know, $2 in 2016 and it's $4 now. Therefore, things are roaring along and we're into good times. Incentive price is a really important concept that we monitor more than actual price. In reality, margins for most mines are not better today at $4 than they were at, say, 250 in 2016 and 2017. And the implied return against the amount of capital you have to spend to build a mine is not better today than it was back then. So, yeah, straight look at a price chart, you could say that things are on the upswing. I still think we're in a kind of a Lukish warm period. There's optimism. That's a difference. There's certainly moments where sentiment is strong, and you're hearing it from the bigger companies that they're all expecting things to get going. But every day, the trouble is that incentive price, the price that's needed to get things kickstarted, the bar just seems to get higher and higher every day on cost structures, timing around permitting, things we've talked about, just more difficult ore bodies that the next generation will be versus the last. So it's really interesting. So we don't see a lot of companies that are at the point that they've decided to push go and they're out looking for the financing now to build their mines. We're just not quite there yet. There's a sense that people are getting ready for that, but royalties and streams typically aren't going to be the whole financing package. You're going to, those financing packages are going to get put together, and royalty and streaming companies will get calls to participate alongside of the other forms of capital when all of the music is playing, right? You need all of those parts kind of ticking along. We're not there yet. So early, the best I can say is we're early, still early in the cycle in that regard. You have to get to incentivization. You then have to start to get the development decisions and announcements. And then there's quite a long period from there while projects are being constructed. And then all of a sudden somebody's put it together and said that there's too much supply coming, and it starts predicting the next rollover. So there's a lot of steps before we go from 2015 and 2016 and what really does in retrospect look like bottoming, to where we'd be to the equivalent, say, of 2010, 2012, when everybody is trying to build a mine. Now, you have to be careful. What commodity are you talking about? Lithium has actually gone through that recently, where the price got such that a lot of projects got funded and built, probably too many, right? And so now that's working its way through. Copper, it still needs to get that traction. Maybe we're there now with gold. So it's less uniform than I'm used to experiencing. It seems you have to be quite specific on your commodity.
So I have to ask you about that incentive pricing on copper. I'm sure you guys have this conversation internally when you guys are doing your valuations of potential royalty projects. Where do you guys think that incentive pricing on copper sits today? Like, is that $6 a pound, $8 a pound. Well, at what point do you think we start to see capital really flow in?
If I look at if we look at the more recent data points on big copper builds and expansions, and you just do some simple math at what price is required, if that's the capex intensity per unit of new production, what price is required to generate a respectable return? You're in the high fives, low to mid sixes for most projects now. Like that's where the party starts, which is incredible. If I thought I'd be saying that even 8 or 10 years ago, that we need $6 just to get things fired up a little bit, I'd have thought myself crazy. But I probably would have said the same thing 20 years ago when it was $1.20, right?
Yeah, we were breaking down Ivanhoe's earnings in a recent video, and it didn't seem like they're exactly swimming in cash at today's copper prices. So like it does seem like it's got to get there. And then we look at things like what happened with Adventus's project. I believe you guys were involved in that one. And it seemed like there wasn't enough incentive pricing there for anybody to want to step up to the plate and finance it.
Yeah, again, like there's two sides of this equation. It's more than that nominal price. If you told somebody 10 years ago copper will be $4 in 2024, they'd probably be pretty excited. Like, wow, that's great. And it's touching $5 at different parts of the cycle. And the reality is that's a shittier price than it was, than $2 was 10 years ago.
Really?
Just, well, the cost side of the equation, the time frames to build these things, all those things that factor into returns have, the negative side of the ledger is accelerated and grown more than that price has.
All right, well, Brian, you've been pretty generous with your time here, and we appreciate that. If I am an investor in Altius or I'm watching the company, what should I be looking out for over the next year? What sort of news flow or developments or goals should I be looking out for from the company?
In terms of sort of big new catalysts, there'd be two that I'd keep an eye on. One is we have a royalty on this project called Silicon in Nevada. It's an Anglo Gold Ashanti discovery. Quite a remarkable one, it seems like. Potentially, biggest gold discovery in the US, if not the world, in maybe as much as a generation. So there's lots of news to come from that project. We expect PFS, PEAs, but somehow this avowed non-precious metals royalty company finds itself with a royalty on what looks to be a pretty darn good looking project. And the other one would be any developments coming from Champion Iron Ore around the Kami project. That's another sort of self-generated project that has found its way to Champion that we hold a royalty on. And so they're busy in permitting, partnering discussions there. So any kind of signals from them around, go forward there. Either of those projects have the potential to materially change how investors look at our business. I mean, I could go on and on about potential other decisions from other operators, maybe Lundin, Chapada, and their expansion plans that we know they have ongoing developments, rebalancing potash prices. All these things are potential positive catalysts in our future, but the first two I mentioned, if somebody's looking for sort of high impact, sudden kinds of changes and developments, those are the two things that we're watching most closely.
Well, Brian, thanks very much for hopping on here. I've learned a lot from chatting with you, and I know that a lot of our audience are retail investors that are often looking for that torquey investment, and there's things that they really need to consider and think about when it comes to making their mining investments. And I'm confident that they got a lot out of this interview, and I appreciate you doing this, and hopefully we can come back on here and chat again as you guys continue to roll out on your strategy.
Look, I really enjoyed the conversation. Thank you so much again for having us here, and we'd love to come back.
All right, everybody. Thank you for watching. If you enjoyed this interview, please smash that like button, subscribe, and ring that notification bell. Guys, also let us know what you think in the comment section and questions that you would like to know the next time we get to chat with somebody like Brian on the show. Thanks, everybody.